Alright guys, welcome to this course on stock market. Now this course will be suitable for you if you're a complete beginner, you don't know anything about the stock market or investing. So this entire course curriculum, what you're going to learn in this video is all these things and more. And subsequently, if you have subscribed to this channel, you'll get lesson 2 followed by lesson 3. And lesson 4, where I'll talk about ETFs. Basically, things you need to know to get started to understand the stock market. And right after that, I'm going to go through lesson 5, 6, 7, where I'm going to share with you how to read financial statements, the basics of it, how to pick profitable stocks, and also what are some of the risks of investing to stocks, and also how to diversify across different kinds of stocks. If you're completely new here, you don't know who I am. I'm a speaker and I speak to people. Before you move on, pause the video to read the disclaimer a little bit, okay? Because stock investing and forex trading is not for everyone. Now, before you start investing, couple of things you need to know and you need to do is not invest $1,000 directly to the market, listening to hot tips, but follow these few steps, okay? The first step, you're gonna make sure that you have at least 6 months worth of savings. Yesterday I read news and it found out that less than 1/3 of people can survive beyond 6 months. So if you have no money, no savings, don't go into investing. Then the second thing is set your investing goals. When do you want to retire? When you earn money as an investor, what do you want to use the money for? Do you want to use it for college? Do you want to use it for retirement? Do you want to use it to buy a house? Write down those goals on a notepad and read it every day. Third thing is understand your risk appetite, because this is going to determine which stock should you buy, which stock should you not touch at all. Okay? Fourth thing, you gotta determine what percentage of my capital should I put into the stock market? What percentage of my money should I save in my bank? What percentage of my money should I put into safer assets like bonds? Basically, this is what people call asset allocation. Now, there's different percentages for different people of different age groups. Later, I'm going to talk about that, okay? Fifth thing, learn proper investing strategies, which is probably why you're listening to this video. Take the time, take the patience to learn. Don't rush it. Way too many investors, they just pick a hot stock tip, then they start from there. Please don't do that, okay? Number 6, take your time to research and find a good broker. And then, right after that, take your time to find undervalued stocks with growth potential. And then number 8, make sure that when it comes time to sell, for example, when the stock reaches beyond its intrinsic value, its true value, then you sell. There are many different reasons for you to sell, but when it becomes overvalued, that is one of the reasons when you should sell a stock. What is a stock? Technically, you're buying a piece of a business. A lot of people think that if you're buying a stock, you're just buying a symbol from the stock market or from your computer. You're actually buying a business. So you're going to ask yourself, before you buy this business, if you're the CEO of a company, would you partner with this company, which is the stock you're going to buy? If the answer is no, because they are not really a good business to partner with, then the answer is no, don't buy the stock. Act like you're a VC, okay? Venture capitalist. If you're a VC, would you invest money into this company? If the answer is no, because of some bad reasons, then don't buy the stock. Every single time when you buy a stock, think of yourself as a CEO or a VC or just a retail investor who is looking to buy a business. This is very important. Change your mindset. Now, do you realize something? Not a lot of people in this world like to buy stocks on discount. But yet, what is weird is that a lot of people, most people, in fact, they are really good at shopping for discounts. Yes, everybody loves a discount, including me. I love it when it goes to 50% discount. I'll buy and buy and buy. But the problem is that most people in this world, all they do is just shop at shopping center for discounts rather than learn how to pick stocks at a discount. When you go shopping and buy something at a discount, you buy a nice hoodie, cool, but what kind of returns it's going to give you? Zero. In fact, negative. Let's say today you go to a shopping center. You saw a shirt or hoodie, price at $150. The next day you come back again, they are selling it at $200. Then you'll be like, alright, too expensive. Everybody knows it's too expensive. But 1 month later, you come back again, they're selling it at $50. Most people are going to buy it very cheap. The thing is, you already have this skill of spotting discounts. Why not translate this skill into the stock market, which is going to earn you money in the long term? Then when the stock market earns you money in the long term, you use that money to buy all the freaking shirt you want. Now, if you translate this same principle of buying at a discount to the stock market, it is almost the same thing. You want to buy below the retail price or the true price, the true value. Because in the stock market, there's this thing called intrinsic value, which is also known as true value. Just like the true value of the t-shirt is $150. And the intrinsic value over time, it changes. It would decrease, it's going to increase, it's going to decrease, and then increase again based on different circumstances. Okay, so when you see the stock price go above intrinsic value, which is over here, alright, anywhere above this red line, it is overvalued. Same thing for this area over here. Okay, so you don't want to buy at these points. Alright, so as an investor, no matter how good the company is, you don't want to buy when it is overvalued, when it is above the intrinsic value. What we as investors want to do is to buy at a discount, just like how most people are very smart shoppers. So you want to wait for a price to go below intrinsic value, which is right here. Okay, and hence the stock will be undervalued. So, but of course, you don't need to be too near the intrinsic value because there's a margin of safety that you need to take note of. But that's for another topic. Okay, that's for another topic. Just understand that when stock price is more than intrinsic value, you exit. If you have a position, then you exit. And also, if you don't have a position and you're looking to buy the stock because it's good, fundamentally good, avoid entering. Wait. And when the intrinsic value is more than the stock price, then you look for buy opportunities. So basically, intrinsic value, you need some time to calculate it. Basically, you project free cash flow to the future and then you discount it with a proper discount rate. In finance, we have this thing called FCF, free cash flow, and also WACC, which is weighted average cost of capital. Again, that's for another lesson. Because this is a basics course, I don't want to confuse you too much. Okay. Alright, so who are the people that is involved directly or indirectly in the stock market? Retail investors who invest and trade at home. We are forever working from home. And of course, we have hedge funds as well as pension funds, stockbrokers, dealers, remisier, stock exchanges. They are also involved in the stock market, which I want to talk more about later on, and also insurance companies and banks and mutual funds, and also regulators. So why is it so important to understand who is involved? Because this thing called volume, who provides the most amount of volume and who has the ability to rig and control the market. So why buy stocks? Why care about it at all? Because first thing first, some people buy it to beat inflation. Some people buy it to grow their wealth, to become rich from stocks, which is definitely possible if you give it some time. And also some people use it to preserve wealth, to save for their retirement, so that they can retire a millionaire and not broke. And some people, they just use it as an additional source of income. They have a 9-to-5 job and they feel that their boss is not paying them enough. Their boss is too stingy. So you know what? I'm gonna make my own money when I come home from my freaking 9-to-5. So if you love your job and you want some extra income, then stocks is also a good place to invest into. And some people just get involved in it to gamble, because you know what, if you want to treat it like a casino, it will become your casino. And also a lot of people, they like the returns, they like the numbers, because if you put your money into fixed deposits, the best interest you get is 2% PA per annum. If you put your money into bonds, you can get about 5% depending on the interest rates. And also whether it's a short-term bond or long-term bond, if you buy long-term bonds, you can get higher returns, but you have inflation rate. That's for another bonds course. Okay. And if you buy, for example, Singapore index, since I'm based in Singapore, you can get about 7%. But STI, I feel that in the long term, it is going sideways. It doesn't give too much upside potential. That's why I prefer US index, S&P 500, Dow Jones, which can give you around 10% on normal times. But of course, if you invest into a stock market crash during COVID-19, there are investors who generated way more than 10%. And Singapore inflation averages about 4%. So if you put your money into the bank, inflation is eating up your money every single year, every single month. In order to prevent that from happening, a lot of people, they put their money into stocks. So before you start investing, you need to know the lingo of the industry. Because for example, if you go to networking and then people talk about, do you know the intrinsic value of Apple? Then you'll be like, what is intrinsic? That wouldn't be so nice, right? So some basic terms: market capitalization. What is market capitalization? Basically, it is the amount of outstanding shares times the current market price, the company's value. Okay, or to put in simple words, how big the company is, how small the company is. Okay. And the next thing, ticker symbol. Basically, this is a symbol used to represent a certain stock. So if you are a forex trader, dollar is represented by USD. So for example, if you take Apple, the ticker symbol is represented by AAPL. The good news is when you use your trading platform, you don't need to memorize the ticker symbol, because nowadays a lot of softwares, you can just type in a company name and then the ticker symbol is going to come out. Over the counter, OTC. Now this is a very common term in the finance world. What is OTC? Basically, everything is traded electronically. There's not a physical place where you can go to trade, to make transactions. Everything is done online, through telephone, through internet. Okay, this is what I mean by OTC, to put it in simple terms. Blue chips. What are blue chips? Now if you go to casino, if you gamble, the blue chip, the blue color chip, has the highest value. Basically, when it comes to stocks, blue chips means the large companies or the industry leaders, okay, which makes them also large companies. And what are dividends? Basically, some stocks pay you dividends. It's almost like interest. When you hold the stock long term, you're looking for the stock to go up, but along the way, the company is going to give you interest. So it's like an additional income aside from the capital appreciation income. And IPO, also a very common term. When people say a company goes IPO, it means that a company goes from private to public. When a company goes public, it will sell shares to retail investors, to public investors. And also pink sheets. Now I know there's a lot of colors like blue, pink. What are pink sheets? If you watch Wolf of Wall Street, you come across this term, pink sheets. Basically, it refers to penny stocks. What are penny stocks? Penny stocks are stocks that trades at $5 or below. Okay, $5 or below. Basically, really, really small companies. Small companies, but the good ones would have high growth potential. That's why it is very attractive to pitch penny stocks to investors. One thing about penny stocks is that if you're a complete beginner, try to avoid penny stocks, because you need to be a little bit more experienced to invest into high risk stocks, which are penny stocks, because these companies are not proven yet. They are still really small. They are yet to make a profit. They are yet to prove themselves that they are worthy of getting more capital. So if you invest into it, you gotta take note of the risk. Volume, it refers to the amount of shares being traded at a particular time. And the next thing, margin. Now in stock investing, you can open a margin account. And a lot of people say, oh, you're trading on margin? Are you trading on margin? So when you open a margin account, it means that you are borrowing money from the broker to buy shares. In other words, you're using leverage. And the next thing, portfolio. When you have a portfolio, it means that you have a basket of different assets. It can include stocks, bonds, currencies, gold, silver, and bull market. It means that the market is going up. And then a bear market means that the market is going down. Stock split. Now, what is a stock split? Now, a stock split means that a company increases the amount of outstanding shares, meaning that they offer more shares. Let's say a company, initially they offer 1,000 shares to the public. Now they are doing a stock split and they're offering 2,000 shares instead of 1,000 shares. So liquidity, basically, is almost the same meaning as volume. How many transactions are being made at a particular time. Okay. So the higher the liquidity, the less likely it is to be manipulated by people with deep pockets. So when you buy a stock with high liquidity, you realize that it tends to be less volatile and also more predictable. When you open an order, it means that you're opening a position. Now orders can come in different forms: market order, limit order, pending order. I'm going to explain more on this later on. Now when people say, okay, I have an open position, what does it mean? It means that you have an open trade, right? You are in the market. You bought a share of Apple yesterday and you're still holding it right now, and hence you have an open position. Alright, so let's move on to the next topic. Now if I look a bit different, it's because I'm recording this 1 month later. So why is it that companies issue stocks? For many different reasons. The first is because they want to raise money. But of course, you can also raise money through bonds. But if you issue bonds, you need to pay it back. So a lot of companies, they kind of don't want to be tied with that obligation. And also, if you have some illiquid private stocks in your company, you can also issue that. But you know the downside of issuing stocks is that you need to spend a lot of time and money to do financial reporting. Because in an annual report, you need to review your plans to investors. In a way, your competitors can also gain access to your annual report. They would know what's your future plans. They would know what's your next step, and they can kind of copy you. And as a business owner, you don't want to reveal everything to your competitors. Okay, so I want to show you a website that is really useful for beginner investors and also useful for investors, and that is Yahoo Finance, because you can come over here, search for a stock, and then get a good summary as to what is happening to this stock price right now. So let's take Microsoft for example, and this was a few months back. I screenshot this. First thing first, you realize that there's a lot of information. Try not to get confused by it. Take it step by step. The first thing you need to take note of is the exchange in which Microsoft, alright, is listed at, and that is Nasdaq. So that's the first thing you need to take note of. And then you can see over here there's different types of numbers. So what do all these numbers mean? So let's go through that one by one. Now the previous close, as the name suggests, it is the previous closing price when the exchange closed. Okay, and open means the opening price when the exchange opened. Alright, and the bid price is the price in which other people are willing to buy, which means that when you are selling, okay, you would sell at this price right now. Alright, so what's this number that follows the bid number? So basically this is actually in lots of 100. So if you take 2,200 times 100, this gives you 220,000. So what does this number mean? It means that there are currently 220,000 pending purchase orders. And ask, like I said, is the price in which other people are willing to sell you. Alright, so which means that when you are buying, you will be buying at this price. Okay, from your perspective as an investor, you are buying at this price. So again, 1,200 times 100, 120,000. This means that there are 120,000 pending sell orders. Okay, so next thing is days range. As the name suggests, is the range in which the price move for the day, and 52-week range. So basically, these two things tell you the volatility of this stock. Alright, so if you are a conservative investor, you might not want to invest in a stock that is too volatile. Volume is basically the number of transactions. So of course, different platforms would have different labels and names, but for Yahoo Finance, this is the amount of volume for the trading day, and average volume is the number of volume for a specified period. So some websites would state, okay, within 3 months, within 2 months. So as you already know, in the stock market, sometimes it can get pretty volatile, and there's a lot of gap risks. Okay, so if you see a massive difference between the previous closing price and the opening price, it means that over the weekend or over the day when the exchange is closed, investors reacted to some major news release, or there's a major downgrade or upgrade in the firm, or there's a major product release. So there can be many different factors, macro and also micro factors. Okay, alright, so that's the part for the left side. Then for the right column over here, let's go through this one by one. So the first one is market cap. You take the number of outstanding shares times current share price, okay, or the current market price. I'll share more on this regarding small cap stocks, mid cap stocks in the next lesson. And beta is basically a measure of volatility, okay, as compared to the benchmark like S&P 500. So if this value is more than 1, it means that it is more volatile as compared to the benchmark, and if it is less than 1, then it is less volatile as compared to the benchmark, and if it's 1, then it's equal. Now P ratio is basically a valuation ratio that a lot of investors use to measure whether the stock is overvalued or underpriced. But of course, this is not a shortcut way for you to determine whether the stock is undervalued or overvalued. It just gives you a quick snapshot. Alright, so basically it's calculated by taking the stock price divided by earnings per share. Now I'm going to go through this again into detail in the next video when I talk about financial ratios. And the next one is EPS, earnings per share. And this is calculated by taking the profits divided by the number of outstanding shares. Again, I'll go through this in detail in the financial ratio video that I'm going to do. Basically, you just need to understand for now is that the higher the EPS, the better it is. So the higher the EPS, the better. But the higher the P ratio, it doesn't mean it's good, because it means that the stock might be overvalued. So next one is earnings date. And again, I told you that I screenshot this a few months ago. So basically what the earnings date is, the date in which the company is going to release their profitability statement. The next one is forward dividend and yield. And basically it's the annual dividend payment per share. And the yield percentage is the percentage return on the dividends. So if you are a dividend investor, you need to look at these numbers. And the next one is ex-dividend date. Now, when companies pay dividends, they need to go through stages. Okay, they don't just pay you straight away. They need to go through several stages. So the first stage they'll go through is the declaration date. Okay. Then the second stage they'll go through is the record stage. And the third stage they'll go through is the ex-dividend date. And the ex-dividend date is a point in time in which the company decides who will be entitled to dividends, because if you don't know it yet, there are different types of stockholders: preferred stockholders and also common stockholders. So normally when it comes to dividend payments, they would pay the preferred stockholders first before they pay common stockholders, in the event that the company goes bankrupt especially. And the next one is one target estimate. Now please don't use this as a prediction, because different analysts, they have different predictions. Over half of the analyst prediction will not be correct. Use this as a confirmation to your own research. And because when I'm recording this video, it is during the pandemic time, this was a few months ago, where they targeted that, okay, Microsoft is gonna go to $193.94. And guess what? Right now it is August as of the recording of this video. I also recommended this stock to you guys in March, when the stock was somewhere here. I don't know how many people took action. My guess is not a lot. Now the stock is at $200. Alright, so if you missed the opportunity, then too bad. When it comes to evaluating a stock, you need to look at the big picture, which some traders call it the macro level, and then you need to go down and look at the smaller picture, which is the micro level. Basically, there are a lot of factors you need to look at if you want to pick a good stock, especially for long-term investment. I'm not talking about trading, because I don't really trade stocks. I'm a long-term investor in stocks. The first thing you need to look at is what business is the company engaged in. Why do you need to know this? Because you need to understand the business. Okay, if you don't understand it, then it's like gambling. So the second thing you need to know is what are the products and services offered by the company, how competent is the management, and also how honest they are, because skills is one thing, but character, that is more important. What are the demand levels for their products and services? What are the revenue sources? How many revenue sources do they have? How many countries do they earn money from? All these are really important. And which part generates the most and least revenue for the company? If you're evaluating an MNC, for example Apple, which country generates them the most amount of money? You need to know that. Which product are they selling that generates them the most money? Is it iPhone or something else? Okay, so who are the competitors? Very important, because if you look at financial ratios, some of them you need to compare with their competitors to the industry average. Okay, so the next one is, are they an industry leader? All these factors help. And also company structure, you need to know that as well. Basically, is the company a corporation or a limited partnership? You can also find this in the annual report. So if you want to invest in stocks, okay, and you don't really like picking stocks, individual stocks, another way that you can earn money through the stock market is by investing into the index. I would say it's very suitable for beginner investors, because index in the long term, it goes up. Alright, and basically what an index is it's a group of stocks, a basket of stocks. Okay, normally index is used as a returns benchmark. When you watch CNBC, people always talk about, oh, the market is going up. Normally what they are referring to is S&P 500 and also Dow Jones. Alright, DJIA. So if you want to know how is the stock market performing in overall, you can look at the index, because it indicates how well a group of assets or investments are performing. Now when it comes to index, I'm going to do a separate video on this, because there are lots of different indexes and there are ETFs that tracks them. For example, you have currency ETFs, you have commodity ETFs, you have emerging market index, and then you have the MSCI index. All these you need to learn. Let's just go through the more popular index first. The first one is DJIA, Dow Jones Industrial Average Index. Some people call this the Dow, and it is a very well-known stock index among investors. So it measures the performance of 30 stocks, blue chips in the US, and it is weighted by stock price rather than market cap. So it is a price weighted index. Now when it comes to index, different index are weighted differently. Some are weighted by the price, some are weighted by the market cap. When it comes to Dow Jones, it is a price weighted index because it is weighted by the stock price rather than the market cap. So since Dow Jones is weighted by stock price, this means that the higher price stock will be given more weightage. So the 30 companies aren't necessarily the best companies or the most innovative, the best companies, the largest companies. It just includes, yes, established blue chips, which analysts feel that, okay, it's a good representation of the diversity of the different stocks in the Dow Jones. And a lot of investors feel that this is not a good representation because the sample size is not big enough, like only 30 stocks in this index as compared to S&P 500 and also another index which is called Russell, or is it Russell, whatever, Russell 3000. So basically this index is calculated by adding all the 30 stock price together, right? Divide by the total amount of stocks in the index, and then they adjust this for stock splits. But with that said, it is still pretty popular among investors. They use this as a benchmark. The next index I'm going to talk about is S&P 500. Now, if you're a forex trader, please bare minimum look at the S&P 500 because it's going to affect how currency prices move, especially the dollar and also low yield currencies like yen, Swiss franc, as well as high yield currencies. Even if you're trading Australian dollar, New Zealand dollar, you need to look at S&P 500 because these two are high yield currencies. They tend to move rarely when the risk appetite increases. Like I said, it's known as S&P 500 and it is a popular benchmark used by professional investors, and it tracks the 500 large US stocks, okay, and then it is capitalization weighted, okay. It means that it is calculated based on market cap rather than based on price. So if you're a forex trader, or even if you're not, you want to see whether people are optimistic, are risk-taking, or are they scared, are they pessimistic, you look at S&P 500 because this is a popular proxy for risk appetite. Okay, so if you want to find a shortcut way to determine the market's risk appetite right now, look at the stock market. If it's going up, it means that investors, they are putting capital into the stock market. They are taking capital away from bonds, money market funds, and then putting it into higher risk assets like the stock markets. Because S&P 500 is capitalization weighted, so companies with greater market value will contribute more to the price of the index. And also when you watch financial news channel, when they say things like, okay, the market is going up, market is down, chances are they are referring to the S&P 500 index, okay, unless stated otherwise. So at this point in time, August, S&P 500 has rallied massively, and at the end of March, somewhere around there, if you look at my past videos, I recommended some stocks while the market was still right here. So it kind of tested this support, if you realize that, and it bounced off. So if you miss out this move, then maybe next time. So another index I want to show you is the Russell 3000 index. So again, this is an index in which people use as a benchmark, and it tracks the largest 3000 stocks in the US that are publicly listed. And just like the S&P 500, it is market cap weighted. Now when it comes to this index, there are actually subsets of this index. For example, Russell 2000 and also Russell 1000. I'm just going to talk about the 2000 index. This index tracks the smallest 2000 US stocks inside the Russell 3000 index, and it mainly comprises of mid-cap stocks and also small-cap stocks. So because it consists of smaller cap stocks, you sometimes realize that this would tend to be more volatile as compared to the index with large cap stocks. So like I said, it would have a higher volatility. So this means that when a recession comes, when this index drops, it's going to drop really fast and really massively, just like how the pandemic started somewhere right here. Okay, and the other index I want to show you is the value line index. So basically you have two types. The first one is the arithmetic and the second one is geometric. If you have been to secondary school, okay, if you paid attention in secondary school, because I believe everybody went to secondary school. If you went to high school, then you would know the difference between arithmetic and also geometric. By the way, secondary school is just a term used in Singapore and also Malaysia. It's basically the same meaning as high school, okay? Now, Value Line Index tracks about 1,600 plus stocks from New York Stock Exchange, Nasdaq, and over-the-counter markets. And it comprises of two types, like I said, arithmetic and geometric. And basically it's the benchmark of the overall market. And aside from US markets, you can also look at other markets, Asia market. For example, Hong Kong Hang Seng Index, Japan Nikkei Index. China, you have the Shanghai Composite Index. India, you have the Mumbai Index. Taiwan Index. Singapore is STI, Straits Times Index. Malaysia is Bursa Malaysia. Philippines, PSEI Index. Some of my friends call it PSI Index. Korea, KOSPI. Thailand, you have the SET, and then Indonesia, you have the JSX Index. So if you want to invest into emerging markets, these are some of the index you can look at. So if you're somebody who would like to invest into emerging economies, okay, you want to take advantage of the potential high growth opportunities, you can look into countries, for example, China, India, which have high growth potential, but with that also a little bit more volatile as compared to the US markets. But generally, most of the time when it comes to index, in the long term, they would move in the same direction. Now I realize that some index, they tend to move sideways a lot, and some index, they are more volatile. So if you want a safe index that goes up in the long term, US would be your best bet. But if you just want to diversify your portfolio, you don't want to put everything into US markets, then you can put some of your capital into the Asia market index. Now the next index is the MSCI index, emerging market index to be specific. And this is something that a lot of investors look at, especially if you are interested in emerging markets. So it tracks the performance of large and mid-cap stocks in the emerging countries, especially China, Korea, Taiwan, India, and Brazil. And relatively higher volatility as compared to US markets. So when there's a recession, you realize that MSCI would drop a lot more than S&P 500. But when times are good, you also realize that emerging market index would tend to give you a high growth rate. But most of the time, you realize that they tend to be positively correlated to each other, US markets as well as the emerging market index. Now, how do you buy the index? I'm going to talk more about this during the lesson where I talk about ETF, because I'm going to move on to stock exchanges. What is a stock exchange? Basically, it is a physical place where you can buy stocks that are publicly listed, okay, public companies, as well as you can buy bonds, unit trusts, ETFs, and also futures and options on the exchange. And that's good because when you go to the exchange, you can see other traders as compared to an over-the-counter market like Forex, where there's no physical exchange. Everything is done online. Stock exchanges used to be popular back in those days, but nowadays a lot of things are just electronic trading. Some of the most popular exchange is the New York Stock Exchange, and some people call it the Big Board. And it is an American stock exchange at Wall Street, okay? And it houses companies with a market value of more than 100 million, so it's pretty exclusive, I would say. Like, not any company can trade at that exchange. And the trading hours are 9:30 a.m. to 4 p.m. Eastern Time. To be listed in NYSE, there are income requirements you need to meet as a company. There are earnings requirements, so it's only for exclusive companies that are making big money, okay? And the next one is Nasdaq stock market. Again, it is an American stock exchange, and it is an over-the-counter market, OTC market, and it has a lower listing. Okay, let me just add this: cost as compared to New York Stock Exchange is cheaper to list there, and also the requirements are not that stringent, and it's populated by tech stocks and also biotech stocks. So you realize that a lot of the tech stocks that you invest in, they are listed in the Nasdaq market. Just now I showed you Microsoft, it is listed on Nasdaq. Alright, so let's move on to the next section, which is types of orders. The first type of order, which is pretty popular, is market order. If you use MT4 platform, it will be labeled as market execution, and it executes an order now at this point in time at the best available price. Basically, if you want to open an order now at this current price, at the current price, then you execute a market order. So the next type of order is limit order. On your MT4 platform, it is called pending order. When you execute a pending order, you wouldn't have an open position now because you execute the order, either buy or sell, later on at a more favorable price. So if you feel that right now the price is a bit too high, you want to enter at a lower price. Then you set your pending order at this level, so that if the price later on does come down to this level, then your order will be executed. Okay, so this is what I mean by limit order. Now stop order is basically the same thing. It is a pending order, and you will execute an order, either buy or sell, at a less favorable price. Let's say, for example, if the current price is here, but you want to enter at a higher price right here, then you put in a buy stop order over here. And normally a lot of traders who trade breakouts, they would use this strategy. A lot of traders who want extra confirmation, they will also use this strategy to put a buy stop above. Just now was a buy limit below, now it's a buy stop above. Okay, so this is a summary of what I taught you just now. Buy limit, current price is here, you want to wait for the price to come down, and you set your pending buy below, hoping the price will eventually go back up. Sell limit is the other way around. Current price is here, you want to sell at the higher price. Okay, so you put your pending sell on top and hoping that the price later on will go down. Buy stop, current price is right here. You want to enter at a higher price, so you set your pending buy on top, hoping that the price would break out and continue to go up from here. Okay, so sell stop, current price is right here. You want to enter somewhere below, so you set a pending sell below, hoping that the price would break out and then continue to go down. So when it comes to investing, there are different investing styles you need to pick and you need to know. The first type of investing style is value investing. As the name suggests, value investing, you buy the stock at the cheap price, meaning at an undervalued price. So let's say, for example, today you go to LV shop, okay, and you see a shirt they really like, okay, and they sell it for 2,500. I think that's the average LV price, if I'm not wrong. LV stuff, please don't kill me if I'm wrong about this, okay? And then because of the pandemic, they cut the price to, let's say, $1,000 for this t-shirt right now. And then it's like, oh my god, so cheap. So not only do services and goods become cheap during a recession, but also stocks, okay? The only difference is that when you buy stocks at an undervalued price, you can earn money from it. But when you buy a t-shirt, it's just a t-shirt in your closet, okay? In fact, if you earn money from your stocks, you can buy 2 more t-shirts from LV or 3 more. So the second type of investing style is growth investing. If you're a growth investor, you wouldn't care too much about whether the stock is undervalued or not, because all you want is just to buy fast growing stocks who has the potential to go up. The stock might be overvalued, but you will still buy it because the stock will still have the potential to go up. But I would say the best approach you should use is to combine both, okay? Combine both value and growth investing together, and then you have a nice combination where you not only buy cheap stocks, but stocks that will go up in the long term. And also, if you're close to retirement or if you're a retiree, you're conservative, that's another approach that you can take, is dividend investing. Basically, you buy stocks that pay good dividends. You don't really care about capital appreciation. What you care about is regular, stable income in the form of dividends. So basically, which one you choose depends on your age, risk appetite, experience, your goals, a lot of things, okay? But generally, the younger you are, or the higher risk appetite you have, then you should go for value growth investing or growth investing. But if you're near retirement age, conservative lifestyle, then dividend investing is the way to go. Because normally when you invest into dividend stocks, most of them are blue chip companies, established large caps, which wouldn't grow as much as the small caps. Now, if you're a dividend investor, you need to take note of this thing called dividend yield, which I taught you just now. And dividend yield is calculated by this formula to cater to the math geeks. Even if you're not math geek, you still need to know this. Annual dividends per share divided by current stock price. So if I'm to ask you, let's say this stock pays you a dividend of $3 and the current stock price right now is at 48. So how do you calculate the dividend yield? You take $3 divided by 48, which gives you a dividend yield of 6.25%. Now this is different from returns ROI, okay? Because returns is calculated by taking the current price minus the initial price, which gives you $3. Okay? Plus dividends divided by initial price. And this gives you a return of 11.20%. Okay, so the formula, if you write it in proper terms, current price minus initial price in which you bought into, plus dividends divided by the initial price in which you bought it, right? So when it comes to stock investing, there are a couple of ways in which you can analyze the stock. First way is technical analysis. Basically, it's the use of charts, volume data. Now, when it comes to stocks, you gotta pay attention to volume. But when it comes to Forex, there's not really any volume data, but the closest way in which you can determine the volume is to look at the COT reports. Basically, technical analysis helps you to find the exact spot of entry, point of entry, and also exact point of exit. And it's very popular among traders, especially retail traders. But please use technical analysis as a filter for your fundamental analysis. Because if your fundamental analysis, if it tells you to buy, but if technical analysis tells you to sell, then you cannot change your mind and then be like, okay, let me sell right now. Right? A lot of retail traders make this mistake of using technical analysis alone to make their trading decision. And also to use this to conflict their fundamental analysis bias. If you see conflicting signals, you gotta put this stock or currency or whatever asset into not wait list, watch list. Okay, watch list. So some of the tools you can use in technical analysis, now you don't have to use all, just use whatever that you find works for you. But the more popular ones in general, even for stock investors, moving average. And a lot of stock investors, they tend to use moving average crossovers to determine whether they should buy and sell, and also support resistance, trend lines, candlestick patterns, chart patterns, price action, and also volume. So the second type of analysis, as you already know, is fundamental analysis. Now this is the study of the financial strength, the competitive advantage of a company via financial statements research. Now this is interesting, financial statements. If you study accounting, there are some companies, in order to impress stock investors, they would tend to edit the statements in such a way that, okay, the company is profitable this year, when in real fact it's not. For example, accounts receivable. Some companies, they can incur the revenue, but then they haven't really received the cash yet. And hence, they don't have a lot of liquid cash on hand. It's just that a lot of customers owe them money. For investors who don't really know accounting, they would think that, oh, the company is profitable right now. It's still legal, but it's not the best for investors. So to put it simply, fundamental analysis tells you where the asset is going to go in the long term. It's more long-term bias. Okay? And technical analysis basically is more short-term bias. In the short term, what is the markets driven by? It is driven by emotions, fear and greed. So in the short term, sometimes you see that the stock price doesn't really reflect the true value of the company, which is the intrinsic value. And that happens a lot of times. So some of the tools used in fundamental analysis, as an investor, you gotta look at the annual reports and the three main statements you need to look at: income statement, P&L, balance sheet, statement of cash flow, and also the footnotes, because it gives you very useful information that the statements don't give you. And investors also do this. They visit the site. So for example, if you invest in Apple, okay, some investors will go to the extent to visit their stores. Are there a lot of customers, or is it always very deserted, if that's the right word for it? Because site visits can sometimes give you information that annual reports cannot give you. Okay. How do you spot a great company? Now, there are a lot of factors you need to take note of, but to put it simply, some of the signs of a great company is if the company has significant market share and also economic moat. This is what Warren Buffett like to focus on. A competitive advantage, consistent earnings for the past 5 years. Their products and services, of course, must be in demand. Reliable and competent management. And also, they must have future expansion plans and the ability to adapt. Now, I realize that so many companies, even during COVID, they went bankrupt. If you don't have a presence online to sell your products and services to people during a major crisis like a lockdown, and your shop is just operating based on brick and mortar, customers have to visit you physically to buy your product and service, then you're in danger when such things happen. And in the past, so many companies have failed to adapt, and then they lose out to the competition. For example, Kodak, they still stuck with film. If you still remember the 90s kids and before, when we take a picture, we need to wait for 2 weeks to be able to see the picture. It doesn't make sense right now, but it is what it is back then. Worst come to worst, the picture comes up 2 weeks later, you gotta pay for it, and then the photo is like either blurry or your finger is at the corner, then it's like... Some of these other factors also help long history, but I would say this is not super important because there are so many companies with long history, right? But they still go bankrupt because they just couldn't adapt. Strong branding, of course, helps. Ability to innovate and develop new inventions, and also ability to compete. Of course, these are the qualitative measures. You also need to get into the quantitative analysis. Okay, quantitative analysis, in which you need to look at the financial statements and also financial ratios, which I'll talk about in the next few videos. So how to pick stocks that are right for you. Now, just now I was talking about how to pick good stocks, right? But what's more important is how to pick stocks that are right specifically for your circumstances. Because which stock you pick would depend on your age, risk appetite, experience, what else? Your goals, whether you're a sugar daddy who is taking care of many different people, whether you're a dad who is living with 5 dogs, 4 children and you want to buy a home for everybody next year. You know, different people have different circumstances. So like I said, depends on your goals, age, other assets you're owning. So this would come into the asset allocation topic, which is again for another video, portfolio allocation, because you need to know how much percentage you need to allocate into stocks, because you don't just put all your capital into stocks, right? You need to decide based on your age, investment goals, how much percentage, 40%, 50%, 60% of your capital should you put into stocks, then maybe 40% into bonds or some safer assets. So a general rule, guideline, please don't use this as a fixed guideline kind of thing, but general estimate for you, okay? Let's say if you're 40 years old, then how much percent should you put into stocks or higher risk assets? You just take 100 minus 40, which gives you 60%. So you should put 60% into stocks, higher risk assets, and then 40% into safer assets like bonds, money market funds. So if you have somebody who is like super young, let's give it a good age, 20 years old, then should you put more or less into higher risk assets? Again, you take 100 minus 20, 80% into higher risk assets. Because you're young, you have nothing much to lose, then you can afford to invest more into higher risk asset. But please, again, like I said, don't use this as a fixed guideline. It depends on other things as well. Depends on your risk tolerance. So if you're a very conservative person, then you might want to lower that percentage a bit. Let's say you're 40 years old, maybe you want to lower it to 50%. And also depends on your investment philosophy. Some people's investing philosophy is like, stock investing is supposed to help me retire within the first 3 to 4 years. Some people feel that stock investing is a long-term kind of thing, it's a marathon, which I personally believe. But I would say investing philosophy is not that important because it's just like a mindset kind of thing. So the next factor I want to share with you is your current income sources and net worth. Do you have a lot of spare cash that you can afford to lose? Because if you don't, then please try not to invest that much, like 80% into the stock market. That's like your wedding money for next year. Please don't do that, because your wife is gonna kill you. And studies have shown that, this is just a side thing, studies have shown that to increase your chances of earning money in the stock market, you're gonna invest into it for at least 1 year. Meaning you're gonna hold it for at least 1 year. And in fact, the longer you hold it, the higher chance you'll make money in the long term, because in the short term, stock prices are just irrational. It can go down even if the fundamentals are good. Your future circumstances, what do you want to buy in the next 5 years? Do you want to buy a house? Do you want to buy a car for yourself? Do you want to pay for college? Do you want to fund your retirement? And also depends on your market experience. The more experience you have, then the more risk you can take. If you're not experienced enough, then I suggest you to take some time to learn it properly first, rather than jumping into the market, which is what a lot of gamblers like to do, stock gamblers like to do. In fact, during the COVID-19, there are so many investing people, or I put it simply, idiots who don't bother to learn investing properly. They just jump to the market hoping that they can make some quick bucks, and only to burn their accounts. So what you need to do is to evaluate all these and maybe score yourself, okay, to determine which type of stocks you should buy. Large cap, more stable stocks, or is it the small caps, riskier stocks? Or you're somewhere in the middle, which you should opt for mid cap stocks. So I'll talk more about small caps, mid caps, large caps in the next few videos. If you don't want to miss out on this, then you can subscribe to this channel if you want to. But if you don't want, it's okay. Then I wish you all the best. So stay tuned for lesson 2 of this course. By the way, guys, I don't have a stock investing paid course. So best thing you can do is to share this with your friends who you think can benefit from it. And if you haven't already checked out the other free courses I have on this channel, I'll put it up on the screen right now, forex course and also technical analysis, depending on which one they put up. You made it through this whole entire course, so hopefully it's going to help you get started properly. So with that, I'll talk to you in the next video. Bye.